Crude oil is once again rattling global markets. Prices briefly surged past $120 per barrel amid tensions in West Asia before easing. As of 10th March, Brent crude was trading around $92.45 per barrel. Now for India, this matters a lot. The country imports nearly 85% of its crude oil, which means every spike in oil prices quickly affects inflation, the rupee, corporate profits, and eventually the stock market. So the key question for investors is this: if oil prices remain volatile, what does that mean for Indian markets and your portfolio? Let's break it down in this episode of BF Special. India is the world's third largest importer of crude oil. According to Axis Securities, every $1 increase in crude prices adds roughly $1.5 to $2 billion to India's annual import bill. That money leaves the country as foreign exchange. And that sets off a chain reaction across the economy. Inflation rises, the rupee weakens, interest rates face pressure, the fiscal deficit widens. The first impact shows up in India's trade balance because oil is priced in US dollars. Higher crude prices mean a larger import bill and greater demand for dollars. Now this tends to weaken the rupee. Estimates suggest that a $10 increase in crude prices can widen India's current account deficit by about 0.35 to 0.5% of GDP. That raises concerns about currency stability and can increase market volatility. For households, higher oil prices mainly show up as inflation. According to Axis Securities, a 10% rise in crude prices could push inflation up by about 20 basis points. Higher inflation limits the RBI's ability to cut interest rates, which can tighten financial conditions in the economy. Rising crude prices also put pressure on the Indian rupee. Higher oil imports increase the demand for US dollars, which weakens the currency. A sharp depreciation can sometimes trigger outflows from foreign investors, adding volatility to equity and bond markets. Oil shocks do not usually cause a full market collapse. Instead, they often trigger sector rotation. Now, some sectors are more vulnerable than others. Aviation companies, for instance, are highly sensitive because fuel is a major operating cost. Industries that rely heavily on petroleum-based inputs such as paints, chemicals, tires, and logistics can also face rising costs. But some sectors may benefit. Upstream oil producers such as ONGC and Oil India tend to gain when crude prices rise because they sell oil at higher prices. Certain refining companies may also see improved margins during periods of price volatility. Meanwhile, some sectors remain relatively insulated. During oil shocks, investors often move towards IT services, healthcare, and banking. If crude prices remain volatile, investors should track a few key indicators: Brent crude price trends, USD INR movement, India's current account deficit, inflation trajectory, RBI policy decisions, and government fuel pricing policies. These signals will help determine how markets respond in the coming months. For more such explainers on markets and the economy, follow Business Standard.